stream. So first off, if you're wondering why I'm on my phone, the reason for that is my Wi-Fi provider just decided to turn off. There's Wi-Fi for everyone in my local area. I can actually see them working from my window right now. That's why centralized providers suck, right, guys? But anyway, thanks so much for tuning in. We know it could be a stressful time of the year for a lot of us. The tax deadline's in about 3 days. Well, the reason why we do these live streams is because we really know that taxes can be overwhelming, they can be stressful, they can be complicated. And we just wanted to take some time and answer the questions that you guys have. So, with me today, as always, we have Jordan Bass. He's a CPA, JD. He owns his own crypto tax and crypto law firms. And as you might expect, he's incredibly busy right now. How's it going, Jordan?
It's going. It's going. Hopefully everyone's enjoying the last weekend before the tax deadline as much as I am, and not running into any complicated issues.
Oh yeah, hopefully. And we also have Miles Brooks. He's our director of tax strategy, and he's had years of experience preparing tax returns for high net worth individuals. How's everything going, Miles?
Everything's going great. It's good to be here. We got last push for the deadline, and excited to be on the other side once that happens.
Oh yeah, I think we all are. But one short disclaimer before we jump into questions here. I just want to reiterate that this session is for informational purposes only. If you have any questions regarding your specific situation, we do recommend that you reach out to your tax professional. Well, anyway, like we said, the tax deadline's in 3 days. You guys have any tips for anyone out there who might, still be finishing up their tax reporting? Miles, we'll start with you.
Yeah, finish up the tax reporting. You're going to want to make sure that if you have any balance due by April 18th is the deadline, you're going to want to make sure that you figure out your taxes and you pay any balance due. If you're just kind of getting started, you're thinking about your taxes now, it's pretty late in the game. And so you may want to consider putting yourself on an extension, in which case, you have the ability to extend when you file your tax return 6 months, but it doesn't still requires you to pay any balance due by April 18th. And so, if you're really, in a tough situation, that extension option is available. You'll still want to use the CryptoTrader.tax software to get as close as you can to whatever taxable income you may have, and then pay tax on whatever you haven't been withheld on already. So that's my advice for people who are maybe freaking out in these last moments before Monday rolls around.
Got it. That's great advice. Jordan, anything you want to add on to that?
Not much. I think that's exactly what people need to do. At the end of the day, it's much better, in my opinion, and I think in Miles' opinion and everyone's opinion, to file an extension and get it right, even if you slightly underpay or if you slightly overpay and you have to owe more money down the line, or you're going to get a refund down the line when you finalize your return. It's much better to do that than to file a return and then amend it and then look back on it and say, oh, when I amended this return, I actually did it wrong again, and now I need another professional to come in. A, it looks bad. B, you're going to incur more costs down the line. So it's better to get it right the first time. If that means you have to go on an extension, millions and millions of Americans do that every year. It's a very, very normal thing to do. In fact, it probably will start to become the norm in crypto, I think, because of the way these transactions are being structured. So I highly advocate for what Miles said, which is it's an extension to file. It's not an extension to pay. If you owe money, you should make an estimated payment. It's very difficult sometimes when you wait to the last minute to get that number, but even a ballpark number is better than nothing, because you will toll the amount of interest and penalties that there will be if you just make no payment at all. And sometimes those things add up and you're unaware of them, and your tax burden becomes not as digestible as just paying the tax, So that's all I would say. And be careful out there with those estimated payments. You don't want to significantly underpay, because still you're going to get hit with interest and penalties.
Got it. Yeah, that's such an important reminder. I mean, I think there's just so many people out there who just think an extension just means you're also just, you don't have to submit that payment until later, also, which isn't necessarily the case. All right. Well, let's hop into some questions from the audience. So I see we have one already from Giovanni here, who says, they purchased some Doge in 2021. They made a huge return, and as you might expect, got a huge tax bill. After that, they, purchased back in at a higher cost basis, but then the price went down. Now they're wondering if there's anything that you can do to release last year's gains. Jordan, you want to start things off?
I hate to be the bearer of bad news in this situation, but if Giovanni didn't sell or trigger a taxable event when his Doge went back down in value, and he just held on to the Doge into 2022, unfortunately, what that would be is an unrealized loss. There's been no recognition, no realization event. So in theory, if there's a large gain in 1 year of, in this case, it was magnificent, $600, I think, to whatever it was. You have $50,000 of gain, let's call it. You're paying tax on that unless you have a recognition event where you harvest a loss on the way back. It's just a gain position that you're reporting for taxes. So if I sell something for $50,000 and I have a $49,000 gain, I buy back in a little later at a lower price, and it goes all the way back down to my original basis, but I don't sell or have any sort of taxable event in that same year. And it happens even if I do sell, but it happens in a subsequent year, that loss is not going to offset the gain that I had in the current year, the taxable year that we're working with, which is 2021. So it's an unfortunate thing. It's why tools like CryptoTrader.tax are so great, because you can realize what you can harvest, right, for losses at year end, and do that so you can minimize your tax burden then. It's really a year end planning exercise. It's not a let's try to figure this out during the tax filing season 4 months after the year ends. So unfortunately, based on the way that question is worded, there's not really much that can be done to minimize that tax burden with that position. If there are other losses, that's fine. You can eat into some of the gains. But based on the way that's worded, there's not really much that can be done.
Yeah, unfortunate. But do you have any tips out there for people who, might have, either last year or maybe they ran into some big gains this year, what they can do if they have like a huge gain like that or a huge tax bill, any steps they can take?
Yeah, ultimately what I always advocate for clients is it depends on their risk appetite, of course, but usually when someone sees a large gain, and large is not, in my opinion, it's not necessarily relative. Someone with a small portfolio and a large portfolio can have the same amount of a gain on a different position. It just might be percentage wise different. But if there's a $50,000 gain, and you know that it's going to bump you maybe up a tax bracket, or you're already a high earning individual, a lot of those proceeds that you generate should be clawed back and reserved for taxes. You could either reserve it along the way, knowing that there's this large burden that could be happening at the end of the year. You can make estimated payments throughout the year. And if you know in Q2 of 2022, you have $100,000 of gain, maybe you make an estimated payment related to that gain, so you don't have this huge lump sum payment at the end of the year. There are things that can be done. It's more of an exercise that is easily understood once you run into this issue, and then you don't want to run into the issue again for someone that it's like the first time this happens. But ultimately, if that's not done and we get to the year end and we have this large gain, there are only a few things that really can be done, and most of it is by way of maybe entering into some sort of installment agreement to pay off that liability over a period of time, which again would be subject to some additional fees, right? So it's not like there's nothing that can be done. Mostly you want to do it preemptively, though, not after the fact.
Got it. That's good to know. And just so there's no confusion about this, I guess the reason why there's not a lot that could be done in this case is because the gain was realized in 1 year and the losses were not realized in the same year. Is that correct, Miles Jordan?
Yeah, that's correct. All individual taxpayers are on that calendar year. And so, if you have all that gain from 2021, you didn't sell until 2022, you have all these losses in 2022, but you're still going to owe tax on your 2021 tax bill. Now, you're not going to figure out what you owe for 2022 until a year from now. And so you have a bill, if you have a big gain from 2021, you have a bill due in 3 days. But you're not, unfortunately, but you're not going to be able to offset anything from your 2022 activity. And even further, if you have a big loss, you're only able to take, if you net your gains and your losses throughout the entire year, you're only able to take $3,000 of loss, of net loss. Otherwise, all that additional loss gets carried forward to a future year. So I think we're in an unfortunate situation, but we can learn from this, like Jordan said. So when you cashed out at $50,000, you paid off some bills. That was the opportunity to pay off some bills, but then also set additional money aside for taxes, knowing, hey, you have an additional bill coming in April. And so that was the time to take out another $10,000 or $15,000 and set aside for taxes. Now you can put this in a stable coin yield, and so you're at least earning interest on it. But it's this is part of why we're out here, educating everybody, trying to get people thinking about this stuff, anticipating some of these tax bills, so they don't get hit by this hit with these huge tax bills.
Got it. That's good to know. So, wow, lots of questions, guys. Love to see it. So here's one. Somebody asked, is swapping USD to USDC a taxable event? Because some exchanges require you to do things like this in order to cash out. So that's one stable coin to another. Miles, you want to take this one?
Yeah. So this is a little tricky. I mean, if I heard correctly, you said USD to USDC. I interpret that as US dollar. You're kind of purchasing USDC with your US dollars.
Yeah, that's correct, Miles.
And so if that's the case, you're purchasing crypto. Stable coins are still considered digital assets. They fit under the cryptocurrency kind of world. And so when you purchase USDC, you're going to, with fiat or with US dollars, that's not a taxable event. Now you own that USDC, and that USDC has a basis, a cost basis equal to whatever you paid for it. Now, if you're transferring or swapping one stable coin, one crypto stable coin for another stable coin, this is also a taxable event because you're disposing of your stable coin. Just like if you dispose of your Bitcoin or your ETH, disposing of a stable coin is a taxable event. Now, the good thing about stable coins is the value doesn't really change too much. So when you do dispose, hopefully there's, only minimal gain or loss. It shouldn't be material to your entire taxable picture.
Right, because stable coins, for the most part, are designed to track the price of the US dollar. So, I mean, there might be a little bit of slippage, but it shouldn't be a huge capital gain or loss. But it still needs to be reported on your tax return, correct?
Yep, that is correct.
Yeah, good to know. All right, so here's another question. Somebody asked about the taxability when you transfer your crypto from one exchange to another and then you sell. First, I do want to say transfers are non-taxable. However, they can create a little bit of complexity, you might say, from a tax perspective. Jordan, you want to take this one?
Yeah, I mean, simply transferring assets from one wallet to another, if that's the question. it's not a taxable event. It shouldn't be a taxable event, right? There's no need to pick up any gain or loss on a transfer. Now, there are different types of transfers. If I heard the question correctly, the question mainly is, would that trigger any tax consequence? Not really, right? There are different things that you can do when you're transferring funds from one wallet to another. And in a reconciliation report, if you're leveraging like a software like CryptoTrader.tax, and you're transferring something from one wallet that you're tracking out to a wallet that maybe you're not, first of all, if it's your wallet, you should, because it's going to create basis allocation issues for sure. But second, that might be something that does trigger a taxable event, that quote unquote transfer, because maybe you're using it to as a spend transaction. Maybe you're using it to acquire something. Maybe you're paying someone for services. So transfers high level, not taxable, wallet to wallet. It's like putting money from my right pocket to my left pocket, or sending funds from my Chase account to my Wells Fargo account. In theory, there are fees that might be associated with the transfer, right? You might have to pay a little bit of gas fees to facilitate this transfer if it's an on-chain transaction. So maybe there is somewhat of a tax consequence there. But usually when we're just, say, transferring funds from an exchange to another exchange, or a wallet to another wallet, there's no gain or loss that's picked up on that portion of the transaction. You just want to make sure that you are definitely keeping track of these transfers that are going to external places that aren't tied to your account, right, to your wallets, because it could cause confusion with a software solution that you're using on where those funds went, and then maybe they come back subsequently, who knows, a couple months from now, but it's again not your wallet. Or two, if it is something that you're transferring out for payment for something, or receiving on the way in, then I see another question. This might be related. After transferring, I'm selling it for my fiat. So if you sell it after the transfer, that's when the recognition event would occur. If you're selling a digital asset, if you transfer it somewhere and then sell it, the transfer is not where the gain or loss would occur. It would happen right after that, when you actually dispose of the asset for your native currency or for another asset, right? So the mere transfer is not really the tax consequence. It's what happens after that. If you're going to sell something, whether it's over the counter or on a separate exchange, that's where the tax implication would come into play.
Right. That's good to keep in mind. Miles, anything you want to add on to that?
Yeah, there is an interesting kind of piece when you're moving your coins from one wallet to another, one exchange to another, is there's this cost basis tracking that needs to take place. All this can be done automatically through software like CryptoTrader.tax, but there's this issue where, let's say you buy Bitcoin on Gemini and you move it over to Coinbase, and then you sell on Coinbase. Well, Coinbase isn't going to know what you originally purchased the coins for. And so if you sell on Coinbase, it's going to look like, you have all this gain. It's going to be all taxed, right? That's what it seems like. That's not the case. If you're able to trace back where you originally bought those coins, okay, so I plug into the software my Coinbase account, it's showing up all gains, no basis. Well, you need to go to and plug in your Gemini account, because the Gemini account has the info about when you purchased that Bitcoin and at what price. And so by using CryptoTrader.tax, you can then pick up that basis. So the entire sell on Coinbase isn't taxed. You're going to be able to correctly calculate what you owe on that sale. And so this transferring from wallet to wallet, exchange to exchange, is tricky for all these wallets and exchanges to track that basis. So that's why you need to use the software. Like, you need to use CryptoTrader.tax. You make sure you plug in all of your exchanges, plug in all of the wallets you've ever used, in order for the software to correctly track and compute what the basis and the gain is on all these sales.
Got it. Yeah, that's good to know. I mean, when I was filing my taxes, I used the system, and I transferred some crypto, some Ethereum from one of my exchanges to my personal wallet, and then I made an NFT purchase. And I was pretty worried about how to report that because it can get pretty complicated with all. But I just labeled it as a transfer within the software, and that filled in the cost basis, and then the whole thing just took a few minutes. So moving on to some other comments, someone said like, my tax accountant doesn't really want to participate with my crypto stuff. Do you have any suggestions for people who might find themselves in this situation? I mean, it's surprisingly common. A lot of accountants just aren't, they don't have their heads in the space the way that you guys do. Jordan, you want to take this one on?
Yeah, I mean, that it is a problem, right? Because if your current accountant, your current CPA, your current tax preparer doesn't want to touch crypto, but you want to expose yourself more to this asset class, it will be difficult to work with them, obviously, because if you have a material part of your tax situation that is crypto related and they're not really wanting to do that, there's really only, in my opinion, two solutions. One, you ask them, hey, can I supplement what you do and just focus on the crypto piece with maybe another professional, and they can provide you the information. I can work with them. We can work together to figure out what my crypto tax portion of my tax return looks like. We provide you with a statement, and then you can file based on those numbers. So you don't have to do anything. You just look at this statement as though it's coming from a brokerage account that's giving me a 1099B. That would be option one if you love your accountant and you want to maintain that relationship, but they just don't want to touch crypto. Or option two, and this is dependent on the person, is you.
Hey, Jordan, I think we lost your audio. I'm not sure if that's just me.
Yeah, I think we lost your audio.
Oh, no. So while we get that resolved, Miles, you want to add on to what Jordan was saying?
Yeah, basically, I think I'm not sure. What else? Maybe we should move on to the next question.
Got it. Yeah. I mean, Jordan covered that pretty well in the limited time that we had with him, but he'll be back on. But as we get this resolved, let's see. So sorry, just going through these questions. Somebody asked about summarizing crypto transactions on 8949. I mean, this is a pretty common thing for somebody with just a lot of transactions in their history. So, Miles, you want to talk about how this works?
Yes. So the IRS requires you to report all of your taxable transactions, your trades, your exchanges from crypto to crypto. And the IRS wants kind of a list of every single one. And so this can be like very voluminous and takes up many, many, many pages. And so what you're able to do is you're able to consolidate all of your transactions into one line item or a couple different line items. And then the IRS still wants all the information, all the transactions. So then you can e-file attach. You can kind of attach onto the tax return all of the transactions that would have been on the 8949, except it's just on an Excel sheet or PDF. You attach it and then send it in with your tax return. This is an acceptable solution to the IRS as to giving the IRS all this information, but maybe there's too many transactions for it to fit on the 8949.
Got it. Welcome back, Jordan.
Sorry about that. I don't know if Miles finished what I was saying, but basically all I was saying was the second option is to find a CPA or accountant or enrolled agent or tax professional that you feel comfortable handling your whole situation. The problem is it's difficult to find because they're very, very busy. And if you wait too long, you're going to end in this position where you're probably trying to figure out all these projections yourself and then having them to work on these things over the summer because they get inundated and these firms aren't large enough to really handle what it is that you might need. So you probably covered something in the 2 minutes I was gone, so I apologize, but that's really the only thing. It's continue to work with that tax pro and supplement what they do with someone else, or with what you can do using CryptoTrader.tax's software, or use that software yourself and maybe file yourself if your tax situation is not as complicated, but the crypto piece is. Or I guess the third option would be, I never advocate it if you love your tax professional, because that's a really important relationship, but maybe you do have to find a different place that's more of a crypto native firm that can understand what you're trying to accomplish, understand the transactions you're entering into, and can actually advise and provide information that's helpful along the way. And it's not just like, oh, I'm on my own and my tax professional doesn't really know, care, or think about the digital asset space. So there's your end of the answer with a 2-minute delay. I'm sorry, guys.
No worries, Jordan. So here's, I think this is a very good question. So someone asked, I'm worried about the infrastructure bill that's around. So this is the one that was signed in November with some provisions on, crypto tax reporting. So is it legal to trade on decentralized exchanges in the United States? Doesn't this bill mandate users or exchanges to share details of the person that was buying or selling? Miles, you want to take this one on?
Yeah. So that's a great question. And this infrastructure bill doesn't really affect individuals directly. Indirectly, it does. But this infrastructure bill puts the attention onto the brokers like Coinbase, brokers like Gemini or Binance.us. And what it does is it forces these companies, these intermediaries, kind of facilitating these trades. It requires them to report this stuff to the IRS. Not only that, it forces them to report this information to each other. So your question about is it legal to trade DEXs in the United States? Absolutely. This infrastructure bill, it's like the bill is passed, but there still needs to be like the rules and how it's all going to play out still needs to be worked out. So there's this like leftover question is, okay, we know the infrastructure bill is going to apply to places like Coinbase. To what extent are they going to apply to decentralized exchanges, anything from Uniswap or, Thorchain? Like, to what extent? We don't know right now. And so is it legal to transact with DEXs? Yes. Is there maybe more information reporting required? Will Uniswap potentially require you to submit a social security number to trade sometime in the future? It's possible. But in terms of the ability for a U.S. resident to transact and continue transacting on these decentralized exchanges, still totally legal and viable.
Got it. Yeah, I mean, even for centralized exchanges, these rules don't start to apply until the 2023 tax year. Is that correct?
That's correct. These exchanges kind of have a full year to make sure their infrastructure, their information databases are able to report all this information. So they won't start officially, they're probably starting now, but they won't officially start collecting all this information and following all the requirements until January 2023.
Got it. And we're almost out of time here. We'll just take a couple more questions. Here's a pretty common one that we hear a lot. This one's from TJ. If I didn't trade or sell, but only bought and held over the past few years, what kind of tax reporting obligations do I have? Jordan, want to take this one on?
Yeah, so not much. If you haven't sold anything, right? If you've just been acquiring spot assets in USD, right, using US dollars, there's not much. But if you're buying an asset, if you say I'm just accumulating, I'm just buying, but the base pair, what you're using to buy that is not fiat currency, it's Bitcoin, it's Ethereum, there's definitely a tax consequence to these transactions. So a lot of things that you're doing, you might not think, oh, I'm triggering taxable events, I'm just buying. That would be true if you're just using USD or even a stable coin that would be pegged to the dollar, because you no doubt would have basis equivalent to what you're selling to buy that asset. but that would have meant that along the line somewhere before you did have some sort of tax consequence. So you should have previously reported activity. But if you're just buying Ethereum, BTC, or even alts that have USD, US dollar trading pairs, that's not going to trigger much of a tax consequence. There's a question on the tax return that you might want to check the box yes. Definitely in years past, the way the question was worded would require you to check the box yes, even if you're only acquiring assets. If you look at the IRS's FAQs and some guidance that they posted this year about do you need to check the box yes or no if you're merely just acquiring assets, you probably don't. I don't see the recourse in checking the box yes, because at some point you're probably going to sell those assets. It's just an informational thing. You're just letting the IRS know effectively that you have these digital assets, and it's such a poorly worded question. It's such a vague question that I just check the box yes. I mean, to be honest, all of my clients have borrows, they have sells, they have acquisitions, they're LPing, so they definitely need to check the box yes. But if I had a client that only was acquiring assets, I'd probably still check that box. So that's the main tax consequence that you need to be concerned with if you're just buying assets in USD, but it's not a reporting requirement on Schedule D or on 8949 from a sale or a purchase of a crypto asset, because you haven't triggered a taxable event if you're just buying with US dollars.
Got it. Well said. So we're a little bit over on time. We'll just take one last question. This one's from Lena. So I generated my 8949 from cryptotrader.tax, and then I received a 1099B showing, my capital gains. So what should I do in this situation? Miles, want to take this one?
Yeah, this is going to be a problem into the future as these, Coinbase and these other exchanges issue the 1099s more and more. It's going to be more and more common for them to issue these 1099s. You're going to want to make sure that any proceeds that show up on the 1099B are somehow reflected on your 8949. So the information showing up through the 1099 should already be integrated into the 8949 if you correctly gave the system all of your transactions from all of your exchanges. You'll just then want to almost tie each sale, or look at the major sales, the kind of the most material sales, and make sure that they're on the 8949 somewhere. Whether you get a 1099 or not, you still have to report all of your income from your crypto activity. And so if you already plugged all your information through the cryptotrader.tax platform, you should have an accurate report that then matches up with whatever exchange issued with that 1099. So you should be in the clear. I would just do a double check, make sure everything's good, and then you should be good.
All right, awesome. And just again, because this is a question we get a lot, there's no need to attach that 1099B to your tax return, right?
Correct. There's no need to attach that 1099 if you're showing all the transactions that you need to. You still need to showcase all the transactions. So if it's not on your 8949, if you have a consolidated 8949, you're still going to want to provide all those transactions. It potentially couldn't hurt you to attach the 1099 as well. If there's technical issues, it's really difficult, maybe you forego it. But if you have the opportunity to attach the 1099 along with your other information, you may consider it. At the same time, maybe that's doubling up, but it probably doesn't hurt you to attach it regardless.
Okay, good to know. Well, like I said, we are over on time, so we'll have to end it there. But thank you guys all for tuning in. If you're interested in getting started with cryptotrader.tax, the link is in the description. I'd also highly recommend you guys follow Miles and Jordan on Twitter as well. They're both very smart dudes, as you could tell from this live stream. Again, their handles are in the description. Well, thanks so much, guys, and good luck before the deadline.
Thanks, Daraj.
Thanks,
Good luck,
Daraj.
everyone, filing your taxes. Again, extension is available if you need it, if you're freaking out. So good luck. I'm sure all of us will be spending time this weekend, if we haven't finished yet, working on our taxes. So, we're in it together. So, just know that there's other people going through the same situation that you are.
That's a great note to end it on. Thanks, guys.